I'm Courtney Hazley with the SEC Small Business Advocacy Office, and I'm really excited to be moderating today's IPO Policy Roundtable. You know, one of the missions of the SEC is to facilitate capital formation, and so we've convened this roundtable to focus on one capital raising pathway in particular, the IPO path. There are a number of reasons why companies go public. There's a lot of value in the public markets. Many founders out there are building their companies with ambitions of becoming public. At the same time, we've seen that the IPO market has been fairly soft the last few years, despite some recent momentum. I'm joined today by some remarkable thought leaders across the market, and I'm really looking forward to a conversation about reassessing the IPO on-ramp and talking about what's working and, frankly, what's not working. And I think, it takes a lot of chutzpah to come to the commission and tell us to our faces all the things we're doing wrong. But in all seriousness, thank you in advance for being here and being part of this conversation and being willing to ask the tough questions on a pretty public stage. So with that, I'll turn it over to you all to introduce yourselves. Jennifer, if you could start by saying, please, who you are and how your work relates to the IPO on-ramp.
Sure, thanks. And thank you so much for inviting me. I'm really thrilled to be back here. I'm Jennifer Zaprelka. I'm a partner in the DC office of Mayor Brown in the Capital Markets Group, but my practice is focused mainly on public company, SEC reporting compliance, corporate governance, and sort of getting early stage companies ready for IPO. But prior to joining Mayor Brown, I was the office chief in the Office of Small Business Policy here at the SEC in the Division of Corporation Finance, which is the office that interprets the rules for public companies. And that office was heavily involved in administering all of the rules that relate to the smaller public companies and pre-IPO companies, exemptions from registration, that sort of thing. Prior to having that role here at the agency, I was a partner at another law firm, and before that I had been on the staff in CorpFin when the Jobs Act was adopted, so I was involved in the implementation of the Jobs Act back the first time around. So sort of long history of being interested in these issues and, play out in my practice now. So I'm thrilled to talk about it today.
Hi, I'm Brad Goldberg. I'm a co-head of the Corporate Governance and Securities Regulation Group at Cooley. Similar to Jennifer, I spend pretty much all my time preparing companies to go public and then representing them post-IPO on governance and disclosure issues. I've been doing this for almost 20 years. Never been to the SEC before, so thanks for inviting me, and it's great to be here.
Hello, everyone. My name is Una Choi. I am Senior Vice President and Global Head of Regulatory Operations at NASDAQ. One of my very important responsibilities at NASDAQ is to manage our listing qualification program, both in the United States and in Europe. And so we have the perspective of over 4,000 issuers who have provided a lot of feedback to us in recent days about this issue in particular. So very excited to be here. Previously, I was a partner at Hogan Lovells, representing issuers and underwriters of all different sizes, focusing on, in particular, life sciences and technology companies in particular. I was a staff at the SEC about 10 years ago, working in CorpFin and dealing with WICSI eligibility matters, which I know we're going to talk about today. And I started my career at Goldman Sachs as an analyst, and I've been with large global companies focused on venture capital investments, M&A, and securities offerings. So it's really great to be here, and thank you very much to the SEC staff for coordinating this.
Wonderful. Hi, everyone. I'm Melanie Neary. I'm a partner in the San Francisco office of Gibson Dunn. My practice primarily focuses on capital markets and securities regulation and corporate governance. And I work with public and private companies kind of across industries, but with a focus on life sciences. And with respect to IPOs, we are helping them with their kind of initial crossover round financings as private companies, IPO preparation, the IPOs themselves, and then life as a public company once they have made that transition. So I love IPOs, and I'm happy to be here today to hopefully kind of bring them back to life in a new way. So thank you.
Hi, I'm Dan Zinn. I'm the General Counsel and Chief of Staff at OTC Markets Group, where I've been for almost 15 years, which is hard to say. We operate public markets for over 12,000 securities all across the globe, including over 3,000 US securities. I think maybe we think of public markets in a slightly different way than the traditional kind of IPO on-ramp that we might focus on, but hoping to add a bit of a different perspective and some other ideas on how the benefits of public company trading can apply to a broader group. And thank you so much to Courtney and the rest of the SEC for having us.
Well, thank you for those introductions. I'll just dive right in. I'm sure you all keep close eye on the IPO market, so it won't come as a surprise to say that there's been an encouraging uptick in IPOs very recently. But I don't think that IPO window has really been open indiscriminately. We've been hearing that unlike during the IPO peak in 2021, current IPO investors have less tolerance for pre-revenue companies, for example, right now. And if we back up a little bit and look at the state of the IPO market, again, compared to that peak in 2021, the number and the volume of IPOs has been down really significantly, and it's been low even compared to other historical levels. So with that context, I'm really interested to hear what you all are hearing from your private company clients as they consider what they're considering what they're considering and what they're weighing, what significant factors they weigh as they're deciding whether or not an IPO is the right path for them. I'll ask you to kick it off, Brad.
Yeah, well, I can tell you firsthand, there's definitely been a dearth of IPOs. Since I joined Cooley in 2021, I think I've done 0. I've worked on several, but they didn't make it across the finish line. There has been an uptick recently. We're definitely seeing more activity, but it's definitely not the same as it was. I think, Una, you were going to give us some stats to just tell us just how bad it actually is.
Sure. I think we can put it into a historical perspective by looking back 25 years. So when you look back to those years, back in 2000, we probably had 7,000 public companies. Now that number has decreased to about 4,500. On the other hand, inversely, we had about 2,000 private companies. Now that number has increased by 475% to over 11,000 companies. So that is, when you look at that on a chart, it kind of goes like this, just very much an inverse relationship. In addition to that, when you look at the type of companies and the size, over a quarter of private companies with a market valuation of over $1 billion have remained private. So, and the others are public. So the question is, what can we do to encourage companies of all sizes to go through the IPO market? And as I talked about before, we engaged very much with both our public company issuers as well as those who are considering to go public. And if I had to just very quickly summarize some of the hurdles and some of the concerns that they have raised, I would group it into 3 buckets. One is disclosure burdens related to the public filings, and we can go into the details about that. Second is proxy process and the need for reform. There is a real hurdle to public companies being able to engage effectively and efficiently with their shareholders. So that's a big hurdle to overcome. And the third is probably sort of other regulation bucket. So the cost of the audit process, the cost of finding good talent on the audit side, both for in-house and through their audit firms. Need for securities litigation reform. That's another area that has come up. And then concerns around adequate research coverage, especially for small companies. So those are some of the challenges that I think U.S. companies face when they're making that decision of to go public or not to go public. And I think when you look at the stats around just the tenure, the lifespan of public companies right now, that number has increased from about 7 years to 11 years. So what that means is that more and more companies are waiting to go public, even if when they do decide to make that jump.
And I think one thing I'm seeing, once a company has decided I want to be a public company, is how do we go about doing that, right? There are a few avenues of doing so. And I would say in the past few years, kind of since the IPO market started to go down, we've seen the reverse merger market start to explode as another path to public company life. And I think the reason for that is the certainty of valuation. So you can lock that in when you're signing that merger agreement versus waiting the 4 to 6 months it can take to do an IPO. And a lot of that is the uncertainty of that timing process. An IPO could move smoothly and quickly, or it could end up taking much longer than expected. And especially with the markets the way they are now, we don't know what the markets will look like 4 to 6 months from now. So it ends up being a safer bet for companies to lock in an IPO, lock in with a reverse merger. And I think if there is a way that we can figure out how to make that process smoother, shorter, and more certain, it would give companies that option. Because I do think the IPO is kind of the gold standard way to go public in many companies' eyes. It's just there's so many question marks around it right now.
Perfect. Yeah, I mean, building on that conversation and the challenges and frictions you've raised, I'm interested to hear thoughts on how the IPO process can be improved to encourage more companies to go public. So basically, what are the fixes, right? What are the levers that the commission could consider pulling? And I'll turn it back to you, Melanie, if you want to kick us off there.
Yeah, happy to. So I think a few initial thoughts and things I see from our issuer clients is there are some large gaps in time throughout the year that the IPO process ends up going quiet. So one, for example, is after January 1, if you are filing a DRS or an S1, executive comp needs to be rolled forward to be that prior year. If you don't have your comp disclosure ready or you're waiting on some end of year numbers, you can't go back on file until you have that year-end comp ready. So I think one idea would be to allow that disclosure from the prior year to be tied to the audit. So when the audit for the year goes in, that's when exec comp needs to be rolled forward. And that, I think, would allow people to start getting back on file in early January in a way that they may otherwise not at this time. Somewhat similarly, there is the February 14th financial staleness date for IPO companies for their Q3 financials. Obviously, it depends on the company, but for many, that audit, that year-end audit, is taking another 4 to 6 weeks after February 14th. And during that time, you're not able to go back on file with stale financials. So one thing I would suggest considering is, obviously we're not going effective with stale financials, but if you could continue to get back on file and work through other comments, be it on business, MD&A, what have you, that just lets the process move more smoothly and takes out that 4 to 6 week window where everyone's just on pause waiting for the audit. One other area we see, and this has kind of fluctuated over the years, but the review process itself, I think, can be predictable, can be unpredictable in terms of timing. From my experience, there have been the unwritten rules of you'll have comments back in 30 days on your first submission, but that, from my experience, has not always been the case. And I think having more guaranteed timelines would allow companies to sit at the beginning of the IPO process and know for certain that if I file on this day, we will hear back from the staff on this day. So I would, things along those lines that just let companies plan out really, like, if we want to be hitting the market in mid-June, let's back up and how do we get there? And just knowing for certain, and we've had great conversations with the staff over the years of trying to hit those plans, but oftentimes those can't be guaranteed, and having more certainty, I think, would make the planning process easier.
Yeah, I think streamlining the review process, getting back to the regular cadence that I think we saw in prior years. I think in recent years, we've seen comments coming from other offices at the SEC and weighing in and sometimes slowing down the process in a way that we weren't typically seeing. So that's something else I think worth addressing, or at least looking at.
Yeah, I mean, just to defend the staff a little bit.
Wasn't it? It's just a factual statement.
I mean, I think that, the intent is to have that cadence be as predictable as possible. I think, no matter where we are, who's in charge of the division, like, I think that the goal is always to have that certainty around when comments are going to come out. But there are times where there will be a comment that comes up sort of later in the process that derails you, that slows you down, that possibly, it's not a rulemaking issue, but it's something for, the folks in Corp Fin to think about. Is there more guidance that can be put out to the market? Is there more information so that us practitioners and our clients understand this is going to be an issue that the staff's going to pick up on, and they're going to throw a comment, and this is going to slow us down, so we have to take 3 weeks to figure it out. So, like, just more transparency into what the priorities are in the reviews, and could just sort of help with that issue of how long it takes to get through the process.
Yeah, I mean, to be fair, when I was an associate, I remember seeing comments come in to be hundreds of comments, and so we're definitely not in the same place. So, these are comments on the margin.
Yeah, definitely.
And just to build on what Jennifer has said, having worked closely and continue to work closely with different international regulators and exchanges, I think one thing that the SEC does really, really well, and we are the global standard in terms of the IPO, is that transparency and that guidance, and also the promptness in comparison to other jurisdictions. And I know it's never quick enough for IPO applicants. So I do think that we have a system that's working really, really well. And I think there's probably some fine tuning associated with that we can think about through the for the IPO process. But just to take a step back, I think the companies that choose not to go through an IPO is really making that choice not because of the IPO process, but because of what happens afterwards. The IPO process is just one step in a long journey. And so I think the question is, what are the areas that we can think about to enhance that public company experience in a way that's going to make a difference for that unicorn to make that decision to go to the market. And I think it's really important to note that the IPO, the public company standard of providing disclosure is obviously really important for the investors, because then it levels the playing field for what type of information they're going to get for purposes of their decision making. And then I think it's also important to note that once companies do go through an IPO, on average, they hire more people than private companies, and they spend more dollars on research and development in comparison to private companies of similar asset size. So I think those are the things that we can think about, and I know we'll focus on that a little bit more as we move forward. But it really comes down to what are the ongoing obligations that are burdensome and does not work.
No, that's a fair point. It's a corporate life decision.
Yes.
Dan, do you have any
I was just
thoughts
going
on
to
the
use
IPO
that as
on-ramp?
my opening to
Oh,
plant a
great.
seed that I'm hoping to tend to throughout the conversation, which is the concept of public companies generally. The discussion here, which, by the way, is fascinating for me to listen to from my perspective on how and why companies are thinking about IPOing, that's only a slice of the public market and public company experience. So, for example, the companies that trade OTC frequently have not gone through a traditional IPO process, but still gain the benefit of public trading. So there's investor access, there's the ability to see your price at any given point, there's the ability to use that public market for future fundraising and for things like R&D. And so I'm just going to encourage the group, and I'll continue to encourage the group throughout the discussion, to think about public markets as a much broader group of companies. And then I think that helps to address some of the issues that you're raising around what are the obligations. So if a public company is not just one type with one set of obligations, then you start to have more options and more availability for them to choose from.
Yeah, no, those are great points. And I think when we talk about IPOs, we're often talking about the stereotypical IPO. And Uni, you said it, right? What can we do to make these unicorns make that call, right? And the stereotypical IPO is that late stage private company, they're revenue positive, they have a top tier law firm working with them, they're working with a top underwriting team, and they've got a big four auditor. And I think that's fair. They're an important piece of the IPO market. but there are a lot of smaller IPOs that happen as well. And I know that we want to make sure we are continuing to support a deep and diverse IPO market in that regard. Smaller companies also want to be public, and there are a number of advantages for them. And so building on ways we can improve this IPO on-ramp generally, I am curious if there are other considerations we should be thinking about for improving the accessibility of that on-ramp for small caps and for the smaller offerings. And I know a few of you in particular are focused in that area. I'm going to turn to you, Dan, because I know you have more to say about small caps.
Just a little bit.
Just a little bit more.
I will rein myself in. But I think the question itself makes a really good point, that there is a drastic difference between the unicorn that wants to access the public market, where the IPO and the IPO on-ramp is absolutely the right decision if they're going to be public, versus the smaller company that has a capital raising need. And that's a lot of why we see even the private markets growing in the ways that you talked about, because there is capital available in a number of different ways for a small cap. And to defend the staff with you, Jennifer, rules like Regulation A, or the Regulation A plus amendments through the Jobs Act that give greater access to what are freely tradable shares for a company that only needs a smaller offering, a $25 million, $50 million, up to $75 million offering. That is a wonderful way to think about accessing the public market. The other ways that companies go public, and we used to call this a slow PO at OTC markets, was to do a Reg D, to do a private raise, have those shares season in the hands of investors under Rule 144, and then become publicly tradable. Again, giving access to the general benefits of being a public company without necessarily all the cost and complexity that a unicorn can handle, but that a smaller company may not be able to handle in thinking about how to grow and how to continue on their journey. And so, again, to water the seed I tried to plant, thinking about public markets in that broader sense and giving credence to companies that maybe start as that small cap that has accessed a Regulation A offering or done a Reg D or other private offering and then gone public, and then we see, I think, 60 to 70 companies per year graduate from our markets to NASDAQ or the New York Stock Exchange. That's a wonderful pathway for small caps to consider that I think often goes unnoticed.
That's perfect. Jennifer, you have a deep history in the small cap space.
Thank you. No, I think that Dan is absolutely right, that there are other avenues to get the smallest companies into the public company space without necessarily doing like that traditional IPO. I think Reg A is wonderful. It hasn't necessarily been the most successful so far in that transition from doing a Reg A to becoming, a listed public company, but there are some success stories, and there will continue to be. That's something that, I think that the commission should think about. What is there something to change about Reg A that would help facilitate that growth where those companies could go list? That's probably for later in this discussion about the after you're already public stage of what you can change to make secondary liquidity more attractive. It's all built up into sort of like when you're thinking about as a company whether you're willing to enter into the public markets, you want to stay in the private markets, assuming you have access to capital in the private markets, which not all of them do, but assuming that you have that choice, what the big thing that you're weighing there is the cost of capital and what that's going to mean for you after you're public. Will you have access to follow-on offerings? Will you get the benefit of being public once you go through the process of doing an IPO? So that's true for the small caps that do an IPO. It's true for the Reg A companies that after you've gone through that, you need to be able to continue to raise money in the private markets, in the public markets. And so Reg A, I think there's room for improvement on how those companies continue to grow after they do their initial raise under Reg A and list on the OTC or, uplist into the exchanges. So that's a great path. There's also, I think, if we're going to think about smaller IPO, smaller companies just going straight to the traditional IPO, this is where we're never going to talk about this more. The idea of like scaling what's involved in that process disclosure-wise, back to what you were saying about the exec comp, that's so relevant for smaller companies. Is there a way to focus in on what do investors really want in a small company IPO? They may not need everything that's in that prospectus. If it's a small company with a very simple business model, low revenue, it's easy to understand that business. So let's figure out what investors really need to have those companies launch, and don't treat them the same as the unicorns.
I'm hearing that there are those other paths available for a wide range of companies, but we're still not seeing enough companies, or I shouldn't say we're not seeing enough. We could be seeing more companies take that path. And so if it's not necessarily or solely the IPO process itself, I guess let's talk about then the other factors at play and the market that otherwise should be supporting and encouraging these companies. So what could be changed to encourage more market participants and intermediaries to be more actively encouraging and supporting IPOs, and particularly for these small caps? And I'm talking about, research analysts, the underwriters, broker dealers, that ecosystem.
Yeah, I mean, some of it I think is sorry, I'm jumping in here. Some of it is structural, that the buy side has consolidated and is dominated by large players who may not always be interested in investing in smaller IPOs. But it's not insurmountable. Those investors are out there. There are definitely investors who are very focused on small and mid cap equity and are excited about this market. They are interested in liquidity. So I think a big part of getting more banks interested in doing these deals and more investors excited about buying these deals is to think about that aftermarket. I was starting to go here already in what I was saying a minute ago. I think research is part of that. It's the momentum after the IPO to support that market. It's people will talk about it, and I think we talked about this when we were preparing for this, that there's a perception out there that maybe the banks are not as interested in taking these smaller companies through the IPO process because they're getting fees on the private market side. I actually don't think that that's a real factor in it. I think it's more that they're never going to make all their money on the IPO process. You make your money in the trading, you make your money in the secondaries. So we need to sort of free up on the regulatory side, like the ability for the intermediaries, the underwriters, the banks to work with these companies post IPO to make it more attractive to them to take them through the IPO process.
So just a couple of things that we hear a lot in terms of sort of the market participants and the intermediaries and other players that are so important to the ecosystem. I think two aspects of it. One is obviously research analyst coverage. And I think it was actually your office, Courtney, that provided some stats on this in 2024, which said that for small and mid caps, only 44% of those are covered by a research analyst. Whereas for mega caps, I think over 70% are covered by more than 10 analysts. So there's a clear imbalance in terms of interest for research coverage. Then that feeds into interest from institutional investors to buy those securities. And I know that there was a 22 report that the SEC had done on this very topic, and I would really encourage the commission to maybe reopen up that research report and see if there are any regulations or deregulation that could help more research analysts and firms coming into this. I know some of it is going to be beyond the SEC scope, and some of the broker-dealer obligations may come from other regulatory requirements, including those from Europe. But I think this is such an important area in terms of creating the right demand for the supply of the securities. The second area that we hear a lot about is related to short selling. So one is in terms of, whether or not there is transparency with respect to short selling positions held in issuer securities. So I think if you were asking a company of any size, I think they would want greater transparency and more periodic reporting of those short positions in their securities so that they can provide better engagement with shareholders and for the shareholders too, so that they can have greater transparency and understanding of the investor portfolio for specific companies. And then the second area that I hear a lot about, especially in recent years, past 2, 3 years in particular, is the lack of oversight around research firms that publish negative reports on a company, but the opaqueness in terms of what kind of short selling positions they hold and what kind of conflicts of interest they have in publishing that kind of research, and also just inaccuracies with respect to the information that is given. And companies are in a really difficult place because it doesn't serve them to go sort of point by point. I mean, they have already provided material information to the investors through their SEC filings. So I think those are areas that the issuer community would really benefit from. And also, it'll help enhance the quality of information that investors will receive as a result as well.
I saw Dan smiling, and we've had this conversation, so I know he agrees with a lot of those points.
I do agree with a lot of those points with respect to transparency of information, not only from the company perspective,
Yes.
but also from short sales and other, where even brokers would like to see increased transparency. And even going back to some of the discussion on intermediaries and thinking about small caps and the impact on small caps, there is, I think, a very well-worn path, whether that's for underwriters or banks or attorneys for that matter, to bringing companies to IPO. And the company comes and says, we're interested in doing a capital raise, and the immediate goal becomes, let's IPO. And that's not going to be right for every company. And I think there's not enough understanding in that intermediary community about some of the other pathways that we talked about exploring a Regulation A. I will sometimes raise it and attorneys will say, I've never done a Regulation A. I don't know what that's about. Or understanding that is a beginning step. And I think Jennifer was getting into some of this towards what can be your life as a public company. And then what we'll talk about, I think, later is helping to address how you do secondary raises and how intermediaries can continue to benefit from that. So building the skills of the industry and the ecosystem that these particularly smaller companies operate in is going to be, I think, a big part of seeing the increase in public companies that we're all shooting for.
Thank you. Yeah. I kind of want to pick up on something you said earlier, Brad, just the dearth of IPOs you personally have seen make it past the finish line over the last few years. And I'm just curious, truly we didn't talk about this in advance, but so who's pulling the report here? And are there things you're hearing from the intermediaries' perspective about what conditions they're needing to see, and if there could be where there might need to be, or where there could be any flexibility in opening up the aperture for what could be an acceptable window, or I don't know, something that is short of exactly perfect. I just was curious what you've been hearing your clients go through, and hear from the bankers and the folks that they're working with.
Honestly, I think some of this is a bit of a perfect storm and maybe unrealistic expectations from the get-go, right? The number of IPOs that we saw in 2021, it may never be repeated again. And I think part of this is not that it kind of just got back to normal, but it literally shut off. I can remember sitting in my office working on an IPO in January as if I had been doing it the last 5 years, just like every January, right? I was working on 1 or 2 IPOs and then having the call saying it's pencils down, and then it never picked up again. And that, I think, was repeated across the landscape in the market, how quickly it just sort of shut off. And then I think you combine that with the number of regulations and rules that came in that time period as well. And then you have companies that are looking for this opportunity. You'll have all these new rules and regulations, which were great for me and, great for you to deal with. But I think just added another layer of, hey, is this something we really want to do? There's all these things we have to, factor in, climate disclosures, all of these additional rules and regulations that came in. So I think that's a big part of this. And I also think, the macroeconomic factors are major, right? the inflation, the tariffs discussions, everything, just when you think it's about to pick up, something else happens. And so I think we're just kind of in that mode, but I am seeing activity, probably for the first time since I joined Cooley. We've got several IPOs in the pipeline, and I hearing that from other firms too. So some of this I just think is cyclical, but there are certainly things that we could do to improve, and hopefully avoid what was, sort of just cutting off the spigot.
That's fair. Do folks think that the IPO process or the IPO market needs disruption? And, if the answer is yes, have any of the suggested changes, would they be enough to spark that disruption?
I mean, I'll keep going if
Please.
you want. I think, and I think you can't have this conversation without addressing some of the other players in this space, namely the proxy advisory firms, and kind of the shadow regulation that is happening in the market, where even if there's not an SEC rule in place, if ISS or Glass Lewis decide that that's something that they want companies to do, then they're going to withhold against your directors, and it's a regulation through these proxy advisory firms, who have conflicts of interest. I don't think it's any secret. I think it's something that certainly needs to be addressed. I think the shareholder proposal process also needs to be addressed. I don't think it's serving the intention that it was put in place for. Special interest groups have sort of taken over people's proxy statements. Again, all of these things put together are not helpful when you're looking at going public and what you're going to have to deal with as far as a whole bunch of rules, but then all of this other scrutiny that comes along with it from these other players.
I mean, I think the topics that we're covering today with this panel and our next session will really do make a difference if they can be implemented. So disclosure, simplification, scaling to the size and the maturity of the companies, reforms in the proxy area. And then, of course, there are some, big issues outside of the SEC's sort of jurisdiction. But if those areas can be addressed, I think we can make a difference. And the reason why I say that is when we hear about these companies expressing the pain points of being a public company, what it comes down to is the cost of having to comply with these requirements and the opportunity cost of not being able to use those funds and resources to build their business. I mean, when you strip everything away, I think that's what it comes down to. And that creates a competitive disadvantage from a cost perspective for public companies versus private companies. And when there is ease of getting venture capital funds and private equity funds vis-a-vis the ease of getting public funding, that's where you start to have issues. And I think we can solve for that. And I think the SEC has the ability and the tools to be able to do that. And I think being open to these type of discussions is really a great step. So yes, I think these issues are solvable. I don't know that everything has to be disruptive, but I think, we're moving in the right path.
Yeah, no, I completely agree. And I think, to Brad's point, the 2021 markets were kind of the perfect environment for an IPO, and it does feel like issuers are waiting for that to come back. And I don't know if we're going to see that perfect again or anytime soon. And any steps we can take to kind of bridge the gap between where we are now and where that was to make it a little easier to IPO, I think would help. But agree, I don't think we're fully at the need to disrupt point, but meeting in the middle would go a long way for many of our clients.
I'm going to use disrupt in the context of kind of disrupting the expectation and even challenging a little bit the idea that 2021 or 2020 was the perfect storm, because now you see, and I think this happens on NASDAQ and New York Stock Exchange, a number of companies struggling to remain listed.
Totally.
I think there's 550 or so companies on the deficiency list for NASDAQ, and several hundred of those are bid price deficiency. We see companies, some of those graduates that have worked hard to become a public company, move up to an exchange, struggle to be able to live as a public company there because of exactly the issues that you're raising, the cost and complexity. So thinking about, again, other ways to access the public markets from a cost perspective, if it's, I've heard various estimates, you probably know better than I do, $2.5 to $5 million, let's say, for a small company to IPO, it's somewhere between 50 and 150,000 for that same company to access the public markets on an OTC market. And then if what they want their story to be is to ultimately, graduate and move to NASDAQ, that's great. If what they want their story to be is to stay and remain public on a market like ours, that's also great. But again, disrupting what the expectation is of the client, which I know is a difficult thing for all the private practice lawyers here, but really from the industry as a whole, I think would make a difference in seeing some of these changes.
What do you think, Jennifer?
Yeah, I agree. I agree with all of this. I think, sort of, and like Una, and I don't think we're at a point where, we need to throw it all out and start from scratch. We're not at a point where it needs to be disrupted. But there are things that can be fixed, and I totally agree with you that it's looking at that cost, making it more attractive as you're choosing where you're going to get your capital, of like looking at where the regulators can reduce the costs of being a public company and sort of the intangibles that go with that. But also relatedly, and a little bit on the flip side, is like, are there regulatory changes that can improve the benefits, right? We'll cut the costs and let's make it more attractive from a post-IPO, what it means is sort of what Dan was saying, your life as a public company after the IPO. There are, I think, some levers that can be pulled that would ease that, help to support, trading, liquidity, and, just the ongoing cost of being a public company afterwards. So it's sort of both sides of like scaling and pulling back some of the regulation, but also like what can be done to sort of facilitate improvements after the fact, so that makes it more appealing than staying private and sort of staying just where you are as a private company.
Structure, the scaffolding for the public companies to be able to sort of maintain their status.
Exactly. Yeah.
Perfect. Well, I'll close it out, I guess, with a final round robin for all of you. Is there anything else the SEC should consider if it's reassessing the IPO on-ramp? And I'll start with you, Dan, and we can just work across the stage.
Sure. I think we sort of touched on some of this throughout the discussion, but so much of the consideration about IPOing or going public generally is about what happens after that. And we talked about whether it's European regulations or other regulators outside of the SEC that have a real impact on that. One of the things that we've heard the current commissioners talk about a little bit is a concept of preemption of certain state law requirements that weigh on companies that aren't doing an exchange listing. So I know preemption is a dirty word in state law circles, but where there is a consensus at a federal level around what the right type of disclosure is or how a company needs to act as a public company, it gets very difficult, and it restricts research in the ways that we were talking about if each state is imposing a separate set of criteria, and you wind up with 40 states that agree on something and 10 that don't. So thinking about areas where the SEC can step in and promote something like preemption to just create a level playing field, I think would make a big difference.
Okay, that's interesting. I'll go to something very specific and coming back to the IPO process, because that's where we're all starting. And I think it will constantly be a challenge of how long that process is taking and the changes that are happening from day one to the day you're pricing your IPO. I think any changes that can be made to shorten that process, keep it moving. One comment I've heard from clients many times over the years is like, but can't we just run our responses by the SEC and get their okay before we submit and wait 2 weeks? And I think clearing comments on the phone has always been kind of a no-no, but to the extent that is something the staff would be open to, just to move things forward and make the process smoother, I think that would be music to many issuers' ears who are in the process and seeing it drag on longer than they thought.
So to wrap up, I think it's really important to just think about why IPOs are important in sort of a broader sense. Obviously, it provides a level playing field for investors to receive information and make their investment decisions. for companies to tap into offerings and capital markets and create generate funds that are necessary. And I know that public companies have been able to tap into trillions of dollars to be able to do that and grow. And also on the other side, public securities are the main way in which Main Street investors are able to grow their portfolio and generate wealth, and sometimes generational wealth as well. So while we are very much open to the commission also thinking about creative ways to provide access to private equity for retail investors and vice versa for private equity to go into 401k, I think the IPO and the public market creates such an competitive advantage for the U.S. economy that I think it's an important area for us to continue to focus on and grow, because there is a core value with respect to public companies having this kind of role in our U.S. markets. And we are still continue to be, and we want to be, the envy of the world in terms of how they view our financial markets and capital markets in particular.
Brad?
I already made my proxy advisory firm point, so I'm not going to make that point again. And I know we're going to talk some about this in the next session, but I think the other thing for me is in echoing Commissioner Pierce's comments that she's made on more than one occasion is getting back to consistency in the regulatory environment, and really focusing on materiality, and so that we're not making these big pendulum swings from administration to administration, regardless of your politics, that I do think has a major impact on kind of how companies think about going public, and because they're not sure what regulations they're going to have to deal with it in any 4-year cycle.
Yeah, I think certainty is sort of the theme here is definitely something that we should keep the regulators should keep at the back of their mind. I keep saying we, as they're, trying to think about how this works. And then, for me, it's just thinking about our smaller companies and, anything that we can do to try to keep the costs of accessing the public markets proportionate for the smaller companies. I mean, we talk a lot about, it's not all one size fits all. I think that's really true in this issue of, thinking about how do we make this work for the smaller companies without sacrificing investor protection, without creating a second-class group of companies that, they're just the little guys. But what do investors really need, I think, should be sort of the guiding principle when it comes to these companies, because it's not the same for the unicorns.
I appreciate those final thoughts from everyone. I think it's been a really fantastic conversation. On behalf of the SEC Small Business Advocacy Office, truly thank you for taking planes, trains, and automobiles to be here today in person, and for sharing all the creative ideas and candid feedback and potential regulatory solutions aimed at helping to encourage more IPOs. I think you've given us a lot to think about. Thank you for joining us today.
Thank you.
Nice.